The 5-year mark for Lehman Brothers bankruptcy is coming up. What is the right gift for a 5-year bankruptcy anniversary? You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I'm Matt Copenheffer, and right next to me here, as almost always, is Hurricane David Hansen. David, you were in Miami over the weekend for the Miami Hurricanes, your alma mater, their football game against Florida. How'd it go?
We got the W, second week of the season, 2-0. That's all you can ask for.
It's not bad. I will say that Penn State, my team, had a crushing victory over Western Michigan. So take that, Miami.
I will.
Well, let's start as always with the headlines. The first one, this is sort of a compilation of headlines from DealBook, has a whole bunch of them here. It's M&A Monday. Let's just put it that way. We've got a lot of deals going on here. Globally, the M&A market slowed down a little bit in the second quarter, but in the U.S., the volume has been picking up, particularly as we go into the third quarter. According to FactSet, there were $95 billion in U.S. M&A deals in July. That was up from $61 billion in June and $76 billion in July of last year.
Right.
And so far in September, we're off to a pretty hot start. We had that big Verizon deal with Vodafone, and then today we've got news on the Dell deal. We've got Koch Industries throwing around $7 billion. We've got a whole bunch of deals going on here. What do you take away from this?
You mentioned kind of off to a good start in September, slowed down in the third quarter. I think it's important to note that the M&A market, it's a very cyclical market. It's going to have all these ups and downs. And there's a lot of people wondering, well, when are we going to return to a normalized level of M&A? There's not really a normalized level of M&A, and the way investors should take it is, if you're interested in Goldman Sachs or you're a Goldman Sachs shareholder or JP Morgan, you shouldn't be trying to time the M&A market and when's the next wave coming, when's the next wave going to fall. I think you need to look at this and say, okay, well, these are the companies that are well positioned. Goldman Sachs, leader in M&A fees. JP Morgan, leader in total investment banking fees. Those are the ones that are going to
You're stealing my data points. You stole my data point,
That's
David.
what I do.
That is horrible.
Those are going to be the companies that take advantage, whether it's a downturn and pick up on the wave, or they're still going to be raking in the fees when things are booming.
Well, I think, like I said, you stole my point there. But I think the point is that you want to be invested in the companies that not necessarily are going to, like you said, not riding the waves, but you want to see who's the leader in all of this. So when it comes to total investment banking fees, I'm going to repeat it because I'm so mad that you stole it. Total investment banking fees, it's JP Morgan. Bank of America is a relatively close second, and Goldman number 3. That's overall investment banking fees. M&A, we've got Goldman as number 1, Morgan Stanley, JP Morgan. I think when you look at those leadership spots, that really says something.
Right. We'll go to the next one, going over to Bloomberg here. It's about emerging markets. BlackRock to JP Morgan see deeper emerging market losses. And they're talking about emerging markets and bonds over there with capital leaving those areas. And the reason this stood out to me was when we think about emerging markets and the American banks and where they're exposed, it's really Citigroup that has the biggest exposure over here. Roughly almost 50% of their revenue comes from emerging markets. So not just international, these emerging markets. And when we think about their investment portfolio, the biggest holding is foreign government bonds. So it's just something to watch that not all of these banks are going to be impacted equally when we see changes in these emerging markets.
I think the question for Citigroup is what happens as this plays out. I think we kind of see, Europe's already kind of a mess, a big mess. But the emerging markets, it's sort of a developing situation. And you're right, Citigroup is the most exposed, particularly of the bigger banks. And my question is, do they maintain the strategy? So number one, are they in a position to not get really killed by something going wrong? And number two, do they maintain the strategy? Because the story at Citigroup is we're a global bank. We have all this global exposure, and particularly to the emerging markets, and that's going to help us over the long term. So as the tough times hit, do they maintain that? Or do we see sort of a replay of the financial crisis here in the US where Citigroup was like, oh, we did all these terrible things and it really hurt us, so we're going to reorganize and get rid of a whole bunch of stuff and sort of rejuggle our strategy.
Right, and it's worth noting, it's not that Citigroup is going in and just betting on these foreign government bonds. Since they have retail operations, they have deposits in these countries, in order to match those deposits with securities, that's why they go and invest in these foreign governments. So it's not like they're just going out and making speculative bets on foreign government bonds. They're matching the deposits they have in the areas with the securities in that area. So it's not that they're being overly risky. It's like you said, though, that is kind of their strategy. The question is, do they stay there?
Sure. Number 3 headline, we're going to finish off with the Wall Street Journal. The headline is Deutsche Bank facing probe in Japan. And the probe is over entertainment. It's said that Deutsche Bank is spending too much on entertainment, and that could be bordering on bribery. So here's my question to you, David. If you're an investment banker, where are you overspending to entertain your clients?
You got to go with the dinners. Nice dinners in Japan. I'm sure that's where the money's going. And it's worth noting, this is alleged based on the people that they were supposedly spending a lot on had to do with pension managers and state pension managers over there in Japan, which are considered state employees. So that's where it kind of rubs the fine line in terms of, is this anti-bribery? So I'm going with the dinners, overspend there. What about you?
Dinners are okay. Little known fact, investment banking clients love skee ball. I'm going to Dave & Buster's and spending all of
Is there a Dave & Buster's in Japan?
It doesn't matter. There should be. If there's not, there should be. All right, moving on to the week ahead. We've actually got a lot going on this week. Last week, there were some big economic announcements, particularly on Friday with the employment numbers. This week, looking ahead to the weekend, all the way out to the weekend, we've got the celebration, we'll call it a celebration, first of Bank of America's takeover of Merrill Lynch, and we've also got the 5-year anniversary of the bankruptcy of Lehman Brothers. So we'll be looking a little bit more at the Merrill Lynch Bank of America situation in a minute. Lehman Brothers, any thoughts on that, takeaways 5 years later? Do you care?
I guess you have to care a little bit.
Do you have to care?
If you don't pay attention to history, it repeats itself. That's the quote.
Yeah.
I don't care too much. When you look at that situation, it was so unique. And I was reading The Economist the other day. They were saying, where's the next Lehman? And trying to predict the next Lehman. I think that's a little bit of a fool's errand there, and trying to find where's the next huge catastrophe that brings the world to its knees. So I care a little bit, but I'm not out there trying to say, this is the next Lehman, this is what's going to cause the next crash. So it's kind of fun to reminisce about it, but I'm not paying too much attention to it.
Yeah, I guess I was being a little bit facetious. I care in the bigger picture, but 5 years out, I feel like there's almost too much focus on that in that era, and not enough focus on moving forward. I think there is a lot to be learned from Lehman and from that whole situation in general, but there's a lot of repair that's been done. There's a lot of good news as well.
And one of the things that keeps coming up about it is, has much changed in the 5 years? It doesn't seem like much has changed. Yes, capital levels are a little higher at the banks, but I think it's important to say that it's only been 5 years. 5 years isn't that long of a time.
I also think a lot has changed.
To get through the cycle of what we went through as an economy, through the financial system. So yes, some things have changed, some things maybe still stay the same. But it's only been 5 years. Check back in 10 years, 15 years, and then we can really see what's changed.
In 15 years, we'll be getting ready for the next crisis. Friday, we've got, on the economic front, we've got retail sales and the University of Michigan sentiment report. Anything we should be looking at there?
I think you're going to see more of the same. What we were talking about the beige book last week, how it's moderate growth. That seems to be the line in every single report. That's what I'm expecting. Again, I'm not trying to predict what the retail sales are to the number, but you just want to see it continue to move in the right direction.
On a month-to-month basis, the sentiment number jumps around a lot, but that one I think is almost better. I would rather look at that than the actual sales data, because I think it's the sentiment that's so stuck in neutral that we need to rev back up. There are a couple financials related conferences this week. Barclays has the Global Financials Conference. That's going on today. That goes through Wednesday. And then Bank of America Merrill Lynch has a real estate conference on Wednesday and Thursday. Among the attendees that I'm going to be watching, because we'll probably get transcripts for most of these, at the Barclays conference, Regions Financial, Wells Fargo, PNC, Wells Fargo in particular, just recently we saw them cut a whole bunch of employees in their mortgage department. Wells Fargo, the U.S. leader in mortgages. So they're cutting back on that department in preparation for maybe tighter times as interest rates rise a little bit and the refinance boom slows down. So I'll be curious to see what they have to say during that presentation.
Yeah, absolutely. And you mentioned those three regions, Wells Fargo and PNC is the last one there. Those are really just traditional American lenders. So you'll be able to get a nice feel of what does the lending environment look like for those banks, rather than a JP Morgan, Citigroup, which have their hands in so many different areas. Those will really tell you what does the environment look like from a lending perspective.
And over at the Merrill Lynch Real Estate Conference, Healthcare REIT is going to be presenting Vornado, and Silver Bay, which is one of the ones I think is kind of interesting. Two Harbors is a mortgage REIT. They had bought up a whole bunch of single-family homes in order to rent them out, and then they spun them all off as Silver Bay. So Silver Bay is now a real estate investment trust that manages single-family homes. I'll be curious to tune into what they're seeing because it's a changing environment for that sort of strategy. We saw Blackstone get into that strategy as well, but the housing market has been, the prices in the housing market have been going way up. And so it's not quite as attractive. It's maybe still pretty attractive to manage a portfolio of single-family homes that you bought at a bargain, but it's tough to add to it right now.
Absolutely.
We've also got U.S. Bancorp is having its investor day later this week. That should be interesting. You were talking about vanilla, regular type lenders. USB is certainly one of those. Also a big hand in the business and commercial lending, so that'll be interesting to hear what they have to say about that. And finally, Chimera, the mortgage REIT managed by the same folks over at Annaly Capital. A couple sources estimate that Chimera might report earnings this week, but Chimera's filings and its accounting have been just such a mess for such a long time now. I have very little hope that Chimera will actually report
more
this.
of just a fun story to watch a little bit with them.
Fun is one way to put it.
If you're not a shareholder, I guess it's a little fun. But
what do you think probability that they actually report this week?
0.1%.
0.1%.
Almost no chance.
What are you trying to Price is Right the situation here?
We'll see.
I will go 10%. So basically, I've got all the upside in the world. Heading to our game for the day, we've got Making the Grade. So for those that are new to this segment, Making the Grade, I'm going to give a situation, a scenario, and we are each going to draw out our grade for that scenario. And the first one we've got here, Heather, you can throw that up on the screen. It's graded Bank of America's 2008 takeover of Merrill Lynch.
Who's going first here?
You can go first because I'm going to take some artistic time with this.
All right. So I'm going to give two grades here. My top grade here is an F. And the F relates to, let's step back and say this wasn't during crisis. They didn't buy them during crisis. If they bought them today, if they did this deal today, this deal, and it had the same results, this deal would be an F. There's no questions about it, considering what they paid, the losses that came from the acquisition. Yes, the unit is doing well from a wealth management perspective. That business is doing very well for Bank of America. The investment banking business, usually top 3 in the world in fees collected, doing very well. But the price, the use of shareholder capital, and the result that they've got, it's just an F. There's no questions about it. My other grade was a C+, and that would be saying, given the situation and given what it did for
That's saying that you can't make up your mind.
Well, a little bit. But given the situation when they bought the company, what would have happened if Merrill Lynch was allowed to fail? I'll give them credit for stepping in. Maybe their hand was forced a little bit. Maybe Ken Lewis really just wanted that investment banking business. I'm giving them a C+ in that. But overall,
so what you're saying is the United States of America owes a debt of gratitude to Bank of America.
Not a debt of
a debt of gratitude.
Maybe
those
just
are,
like
those
a
are
hat,
the words that I was
hat
hearing.
tip, maybe. But a normalized acquisition of this nature is an F.
You heard it here, folks. David Hansen says that Bank of America is waiting for a big thank you from America. Here's my grade. If you can see that there, I've got a little smirky smiling face with a light bulb going off right above it. And I'll tell you why I went that direction, David. Smirky smiling face, it was a an overly clever move. This is Ken Lewis trying to build his empire. Ken Lewis was still the CEO at the time. This is before your buddy Brian Moynihan took over. So he was trying to build his empire. So he's got this good idea here, and they bought the bank, or they bought the investment bank. Like you said, they paid way too much for it. But I am not concerned with that right now, because
Explain.
well, I'm about to, if you're not going to. So this is 2008 that they paid too much. And this is under different leadership that they paid too much. So I'm looking at it today, and I like the fact that they have the thundering herd, all of those brokers over at Merrill Lynch. I like the fact that they have a much stronger investment banking presence. Like you said, top 3 in the world in total investment banking fees. Back in 2008, they weren't also ran in investment banking. If you were an investment banker, it was sort of like, oh, Bank of America, they have an investment bank? That's really strange. I had no idea. Today, it is a much, much different situation. So I'm fairly happy from a today to go forward perspective on Bank of America owning Merrill Lynch.
Fair enough.
Number 2, got the slide up here. The second one is the U.S. government's bailout / conservatorship of Fannie Mae and Freddie Mac. David, what is your grade?
Again, I have 2 grades for you here. The top one is an F.
Can't play by the rules, can you?
The top one is an F, and that relates to anyone who was a shareholder of Fannie Mae or Freddie Mac, or anyone, frankly, who is a shareholder today. Given the nature of the conservatorship, doesn't look like common shareholders have a clear path to prosperity here, if you will, in terms of having the situation turn around, having the firms reprivatized, and them getting some of the capital back that used to be entitled to them, not anymore given the terms of the conservatorship. My second picture there, or rating, is a family with a house, and the son is smiling. Everything looks good. From that perspective, the bailout, conservatorship, what have you, of Fannie Mae, Freddie Mac was successful. The U.S. mortgage market, the housing market, did not seize up. Credit continued to flow to borrowers that were not underwater, that could refinance. Say you had a 6% loan, take advantage of the low rates at 3.5%. That did a lot for the American consumer, American households around the country. So the fact that they were able to maintain liquidity in the market, keep mortgage access available.
They saved the world.
To families.
They saved the world.
I don't know if they saved the world, but
I'm just trying to summarize it.
It did a lot for American families, so giving them a smiling sun face from that perspective. What say you?
All right. This right here, that's an 8. That's an 8+ actually. And I started out with a 7, and then I added a plus to it to make it a 7+. And then I decided, no, I'm going to give it an 8. And I will probably not make very many people happy, former shareholders, current shareholders, very happy when I say, I don't really care when I'm thinking about this. I don't really care about the shareholder situation. I think Fannie Mae and Freddie Mac were pretty much toast during and after the financial crisis. That was thanks in not necessarily just to bad lending, but also the amount of leverage. It's dizzying the amount of leverage that they had at Fannie and Freddie. Why I said the 8+? Because number 1, kept liquidity in the housing market, and I think kept the market overall moving so that we could get to where we are today. I don't know that would have happened if Fannie Mae and Freddie Mac had just gone under or couldn't function anymore, couldn't do what they do. Number 2, I think it's going to end up being a pretty nice return for the government. So it is looking at this point like they're going to get all of the money back that they put into Fannie and Freddie. And it's looking like they're going to get a profit on that eventually, hopefully. And this will depend on how long it takes to wind them down. And notice I'm not saying if they wind them down, I'm saying how long it takes to wind them down. And so to me, that's a good outcome. They helped keep liquidity in the market, and they're getting a good return on the investment. And okay, it's not great to be an investor in Fannie and Freddie, but it wasn't great to be an investor in Lehman Brothers either. It wasn't great to be an investor in Bear Stearns. It wasn't great to be an investor in, frankly, Citigroup. I mean, if you were an investor pre-crisis in Citigroup today, AIG too. So there's a lot of that. But overall, I think the bailout conservatorship of Fannie Mae and Freddie Mac was a pretty darn good move.
I agree.
Finishing off, as we always do in the Twitter sphere. Take us out, David.
First one we are looking at today is from Crowd Turtle, who's at Crowd Turtle. Genius lay in the ability to recognize the point of maximum pessimism plus or minus 6 months. So we were talking about the financial crisis 5 years ago. So 5 years ago, I would say, I guess, March 09 was probably the maximum point of pessimism for the financial markets there. Obviously, we're past 6 months with that. That's really where the genius would have been if you started investing in financials at that point, at the height of pessimism. Obviously, past that, do you think that there still is a lot of pessimism out there? And maybe not necessarily we're going to see the 100+ returns over a couple years, like we've seen with Bank of America, Citigroup. Is there still room for investors to make healthy returns in this space?
Sure. Sure. I mean, look at the valuations. The valuations don't suggest that there is optimism. I mean, maybe there's more of a neutral feeling at this point, but it's certainly not optimism. And I think, frankly, it's still pretty pessimistic. And we are obligated to do this caveat every time we talk about this, but even if you're not rooting for pre-crisis era valuations, there's still a middle ground where you can say, okay, Bank of America, when it gets its expenses down, when it starts earning the way it has the capacity to earn, is that a 2 times tangible book value kind of bank? Yeah, probably. I can see it trading at that. It's closer to 1 right now. JP Morgan, should that be probably trading at 2 times tangible book value at some point? Yeah, probably. It's closer to 1.4, 1.5 right now. So I think there's still a lot of room. And remember, it's not just this one and done kind of move for JP Morgan from 1.4 to 2, because in the meantime, you have the continual generation of tens of billions of dollars of capital, some of which goes out in dividends, some of which goes into share buybacks, but a lot of which gets added to the shareholders' equity. So the shareholders' equity continues to grow. So it's not just, okay, move up to 2 and then stop moving. It's move up to 2 times book, and at the same time, that shareholder equity is growing.
Yeah, I agree. I think it really is. Like I said, I don't expect JP Morgan to double in the next year like we've seen some financials do. But that doesn't mean you can't get very solid returns from a risk-reward perspective with financials. I think that's still attractive till today.
Were you a genius?
Was I genius? I wasn't genius. I wasn't buying financials.
Will you be a genius the next time around? Is the question.
We'll see.
Okay. Tweet number 2. This is from Unrelated Nonsense. That Twitter handle is at non-related nonsense, or non-related sense. Non-related sense. Okay. The tweet is, when a large asset manager starts cheerleading for one of their positions, is it safe to assume they don't want to buy more? No. David?
It's an interesting question. I mean, the one that popped to mind was AIG. So we just mentioned the pessimism, the 6-month window there. I don't think we're in that 6-month window with AIG anymore. You've seen hedge funds, one of their top holdings, fund managers like Bruce Berkowitz coming out and cheerleading AIG, the road to recovery there. So I think it does have a point, but I think it's kind of related to the first tweet we looked at. AIG's been a great stock to own. It's had a great run. You may not see that duplicated in the same time period, but I think you can still expect attractive returns for a company like AIG, a stock like AIG. It's an interesting point. I'm not quite sure. I don't think it's, if a fund manager starts talking about their book, you should sell it, because I don't think that, but it's an interesting question.
I think it's an easy conclusion to jump to. They're talking about it. They want to just push the price up and get out of it. But at the same time, and AIG is a particularly interesting case, we could say, because you do have such a high concentration of hedge funds moving into it. It is a hot idea. It is legitimately a hot idea. But look at the valuation. The valuation is still considerably below tangible book value. So if you really had that much money moving into it, if you really had, and there is legitimately hedge fund money moving into it, but hedge fund money isn't really the real money. There's the pension fund money, the mutual fund money, that's the real money. So if we saw real money moving into AIG, you'd see the valuation go up. It's as simple as that. And we haven't really seen that. So it's a hot idea, which makes me a little bit uneasy, but I don't think that it's run away yet. The other thing I'll point out here is, over at Berkshire Hathaway, how long has, and Warren Buffett isn't a mutual fund manager, but there's a significant sort of mutual fund component at Berkshire Hathaway. How long has he been cheerleading Wells Fargo? How long has he been cheerleading American Express? Maybe American Express is a bad example because he hasn't been adding to it. But Wells Fargo keeps adding to that position, keeps cheerleading it. So I don't know. I think it depends on the manager, depends on the person. I'm sure you could find examples of where they're cheerleading it to push it up and get out or something like that, and you wouldn't want to be buying. But I don't think that that's a clear signal.
All right, moving on to our last one. It's football season. And the tweet is, hashtag fantasy football is a poor man's stock market. So stressful. Points keep going up and down. Hashtag NFL, hashtag football, hashtag sports nation. Was it a stressful Sunday for you, Matt?
It wasn't, because what was I doing yesterday? I was out and about. I think I was doing chores most of the day yesterday. So I had the games.
You weren't watching the fantasy football box score there?
No, that's what I was doing.
We're doing
I wasn't watching the games closely. I was watching my mobile app closely. And you've mentioned this on the show before about the fact that I only check my stocks really once a quarter or so. I try to check them very seldomly. With fantasy football, not so much. I was probably checking every 5 to 7 minutes yesterday. And I wouldn't say that I was stressed out, but I was very attentive, we'll put it that way.
Yeah,
I was also attentive to the fact, by the way, that I had a much better Sunday than you did, Dave.
Okay, we'll see. It's a long season, but it really, I mean, we're not the first ones to say it, that fantasy football and investing, there really are so many parallels here. When you look at David Wilson, Giants running back last night, 2 fumbles, everyone out there saying, I'm dropping this guy, I'm done with this, I'm done with this player, I'm done with this stock, it's terrible, it doesn't do anything for me. Then you have someone like Anquan Boldin of the Niners, great game, everyone's out there saying, we gotta go out and buy this guy's the next big thing. Just goes to show you that, like you said, there are so many ups and downs in this.
Anquan Boldin on your team in fantasy football. Where was he yesterday?
Number 1 spot on the bench. Didn't take advantage of it.
That does not help you out too much. That's like having Apple on your stock watch list over the past decade.
Exactly.
All right, that's all for us here today, folks. I'm Matt Copenheffer. Again, this is David Hurricane Hansen over here. Thanks for watching. We'll see you tomorrow.